Hi there, back to the class. So last time we were talking about what is an asset class. So the asset class is a group of investments with similar risk return profile. And what do we mean by risk return profile? That we will come back very soon. But basically, what you have to understand is how is the risk defined. Now, as you know, there's something called business risk in everything. So that's a different kind of risk. Like when you do entrepreneur and then you try to basically start a business and the business fails. But when you're talking about an asset class, for example, a stock or anything that has a return series, a historical return series. Now I know you are going to get confused by this. What is a historical return series? But what I mean by that is that if you go and look at the price of the investment vehicle, it could be an individual stock, it could be an exchange traded fund, it could be a mutual fund, and you can go to probably Yahoo Finance or some other site that gives you the quotes, and you can get a historical returns for that particular investment vehicle. So in that case, what you do is that you basically have a risk, you have a return series, the a series of prices um, sorted by that date maybe. So so that's your input sometimes, like because many people they look at the historical prices. So risk and return, I'll come back to how to define risk, how in finance or in at least in academic finance, how do they define risk? I mean, it's a very broad term, but I guess we have to start somewhere. And one way to see how risk is defined is by taking the example from academic finance. So now coming back to the second thing, which is what are the all the asset classes. So now you see the examples of asset classes are stocks, bonds, cash equivalents. For example, an example of cash equivalent is, for example, CDs, or you could have things which are basically highly liquid, but even your savings account could be considered a cash equivalent. There are REIT. What is a REIT? The REIT is Real Estate Investment Trust. Basically, the word stands for acronym REIT. REITs are actually stands for Real Estate Investment Trust. Now, real estate investment trust. That's real estate is an asset class by itself. Now, coming back to commodities. Commodities examples are gold, silver. Um, it could be as simple as that as other things like grains, corn, soybean. These are all commodities. But the most people, when they think of commodities, the gold is considered a good hedge. So we'll talk about where is gold. Should we have gold in our long-term portfolio? Now coming back, and then there's another asset class known as currencies. Now that's highly volatile, and I wouldn't recommend for an ordinary investor to try to put money in currencies. But in any case, so these are the asset classes. Now, are foreign stock a different asset class or just a category within stocks asset class? Very good question. Very good question. What we have to understand here is that now within an asset class like stocks, you can have variety of categories. For example, you could have domestic stocks, you could have foreign stocks, you could have and then there are many different categories within themselves. For example, if you take domestic, you could have large cap, you can have small cap, you can have value, you can have large value. I mean, there's like many possibilities there. And each asset class tends to have its own risk return profile. and I will come to that. And risk return profile is basically how we measure risk and how and then the returns, like what do we mean by returns. So I'll come to those things soon. Let's go to the next slide. Risk, exactly. So this is the thing I was basically going to talk to you folks about. What is risk? The most important concept in finance, in my opinion, is risk. Now, before you invest anywhere, you have to understand what is risk. There is always a risk in investing. You see, if there's a riskless investment, like maybe savings account or a CD, fixed deposit in a country, unlike in a country which is highly stable, like for example, United States or Germany, which have very solid, very deep financial markets and a very established financial system, maybe that could be considered, can come as close as possible to risk-free investment. But everything else has risk. Basically, everything has risk. So you start with stocks. Anything can happen. You buy in a hot stock, and then you find out that the CEO, who was the brain behind the company, basically had some strange um, hobbies, and he ended up drowning himself while surfing. Let's just say that could be one. Or he may be interested in paragliding or scuba diving, who knows. And many of these hobbies have come with their own risk, and not to confuse this with financial risk. But so my point is, risk usually in finance, they're divided in two categories. One is the idiosyncratic risk, and other is the systematic risk. Now, what is idiosyncratic risk? Idiosyncratic risk is, for example, what happens is that, as I gave you just one example of his a company which was basically all resting on the shoulders of the CEO, and the CEO um, ends up getting involved in an accident, and something like, imagine what happened to Apple when Steve Jobs passed away. So that's some kind of a, I would say, idiosyncratic. This could also be something like, imagine if somebody put all their money in Enron, and they found out that Enron basically was cooking its books, which in plain language basically it means uh, they were their accounting statements were fraud. So that is another example of idiosyncratic risk. So usually what happens is that when you try to invest for the long run, you want to avoid these kind of idiosyncratic risk. You want to go in what is known as systematic risk, because you want to basically cancel out all the idiosyncratic risk, and only risk that you take is systematic risk. And what the finance theory says is that the systematic risk is the one that pays off in the long run, and the idiosyncratic risk, you never know what might happen. You might be Warren Buffett, and you know business very deep, and you could be making a lot of money just by choosing individual stocks. But this is obviously this tutorial is not for the investing geniuses and people who have business in their blood. It is for people who are born maybe not so financially savvy, or they did not get this financial savviness from their families, or they're more like scientists, engineers. They have other hobbies in life besides money, and they never concentrated, focused on the business side of the life. And then but they still, everybody has to have money to survive. So you end up having a lot of money in the end, but you don't know how to invest. So it is for them. So um, in finance, so now in layman's term, you could say the risk is the chance of a loss. Basically, you could lose money. Basically, you put X and you might not get even X back. Forget about growing. So that's risk. Basically, that risk is the chance that you could lose your principal. Now, another way to define risk, which is very now let me just warn you that this way of defining risk is very academic finance, and it is not so much. It is not so much that it is completely uncontroversial. That a lot of people actually think that that is not the way the risk should be defined, because I'll come to that later. But basically, let's just say that the risk. One way to define risk is it's basically the variability of the returns of a given asset around its expected return. Now, what is expected return? Expected return is the return that you that in a way you could say it's the average return, the mean return, like over many different states of the world, many different scenarios. So every asset class is supposed to have an expected return. For example, S&P 500, the expected return used to be, in a very broad sense, let's just not go into inflation and all, used to be around 10% over long period of time. It's not like if you buy an S&P 500 ETF for like 6 months and then expect to get 10%. No, that wouldn't be expected return, or you might not. But basically expected return says that if you hold S&P 500 ETF for very long time, for 10 years, more than 10 years, 15, 20 years, you're supposed to get 10% with 20% deviation. So the expected return is that 10% part, and 20% is the standard deviation around the 10% mean. And that 20% standard deviation is what academic finance tries to define as risk. So the risk is the variability of the returns of a given asset around its expected return. So a risk averse investor requires greater return when risk of an investment increases. So now let me ask you this. Why would you invest in something which is basically which gives you more risk but less return, as opposed to another investment B which has less risk and more return? Obviously everybody would choose B over A. If you have A and B, and A has more risk and less return, and B has less risk and more return, everybody would choose B. So that's the definition of risk averse investor. Investors are risk averse. So a risk averse investor would always require more return for more risk. That's how the rational investors basically behave in the market. Now, so let's go to this one: historic expected returns of different asset classes. Just to give an idea of this risk return profile, this is one way. So as I said before, I move on from this slide, let me just tell you what is risk. So the risk, one way to define risk as opposed to many other ways, is the standard deviation of return series. Now, what is the return series? As I said last time, just few minutes ago, the return series is that you have bunch of returns sorted by the dates. So you have a series of returns over a period of time for a particular investment vehicle. It could be an individual stock, it could be an asset class, it could be a composite um, investment vehicle made up of many other asset classes. It could be anything, but as long as you have a return series, bunch of returns in column B and a bunch of dates in column A, that's known as return series. So now historic expected returns of different asset classes. Stocks usually 8 to 10% dividend reinvested is assumed. Long-term corporate bonds is like more like 5.3%. I mean, these are not, don't take these numbers as like hard and fast, but basically what it's saying is around 5%. In long-term corporate bonds, more reaching like 6%. Now these are all historical, remember, and U.S. Treasury bills is around 3 to like 3.7% or something like that, 3%. Now these are all historical. So one other thing you have to assume is that how do we in finance, how do we model the expected return? We have to have a lot of data. Everything starts from data. Otherwise, in academic finance, it will be very hard for you to basically work with these things. So the idea is you have a bunch of data, and the data is basically has a lot of this data has this one example of the data is return series, and you could do things like take a standard deviation on that return series. You could take mean of that return series, and when you have enough data and these things, we kind of start classifying as we start coming up with models like expected return. Expected return is a very statistical concept in the sense that it assumes that you have a lot of data in aggregate over a long period of time over many different scenarios. That would be the expected return. That is, expected return is not the guaranteed return that you get on a asset class over this period, but it says that this is what we expect, this is what is historically has been seen. So so this is just to this slide gives you an idea of the different asset classes and their expected returns. Now let's go to the more deeply into stocks. And what we see is the stocks is a fractional ownership. What are stocks really? I mean, think about it. What are stocks? Stock. Another word for stocks is equities, and equity owners have the last claim on the. Now, let me ask you one question. Why do you think stocks should have higher expected return than bonds? Because if you take the financial structure of a company, you would see that the equity owners have the last claim on the company's assets. So imagine there's a company, and if you know anything about balance sheets, the balance sheet says the assets equal to liabilities plus owner's equity. So when a company goes bankrupt, what you see is that the equity owners, they have the last claim on the company's assets, meaning you pay off all your debtors, the bondholders, everybody, and then the equity owners, if something is left, they get. So that means basically what I'm trying to say all this is because equity owners have more risk, and because they have more risk, in general, they have to be compensated more, meaning their return should be more. And basically, what is in a stock? It's a fractional ownership in a company. Now, because equity holders have high risk, they need to be paid more. So that's why, therefore, equity owners expect higher expected return in the form of dividends and capital gains. So that basically should tell you why stocks have higher expected return than bonds. So now more about stocks. Now let me tell you all the different kind of stocks. So domestic versus foreign versus emerging markets. Domestic is, for example, your S&P 500 could be one example of a domestic ETF or domestic stocks. The stocks in the S&P 500, they are domestic as Apple. In a way, you could say they are domestic, but if you think about many of these companies, S&P 500, they are multinational companies, so they are exposed all over the world. So it is not like, hey, I put my money in Apple, I'm completely now exposed only to the US markets. No, it could be that Apple stocks is suffering because something happened in China or something happened in India. So basically, domestic basically means it is listed in this case on a domestic stock exchange. But some companies may have completely very strictly domestic exposure. It's quite possible. Now, foreign stocks are the stocks in, for example, Europe, EMEA, and Asia Pacific, Japan, Middle East. Emerging markets examples are like, for example, Brazil, Russia, China, India. They call them BRIC actually, and many other countries. There's another category known as frontier stocks, but we will not go there. Now, many different categorization of domestic stocks. For example, you can categorize, you can subdivide them by market cap, large cap, mid cap, small cap. So the large cap is, for example, Apple is a large cap stock. For example, Google is a large cap stock. And then you have a small cap stocks, that any company which is less than, let us say, maybe like a couple of $1 billion in market cap. Then you got a style, growth versus value. Now the old companies, for example, IBM is a value, would most likely be in the value category. And some companies which are new, for example, maybe Uber, maybe Airbnb, they could be considered growth companies. Now, dividend versus growth. So that's another way style of thinking about investing. Like many people, they prefer dividend, not so much growth. I mean, growth is fine. Everything is fine. It's not like it hurts them. The company is giving them growth on top of dividend. But basically, you have to understand that finance is all about trade-off. You can't get something for nothing. If there is an advantage you're getting, you have to pay for it. So basically it's very unlikely that a company would be highly growth oriented company and giving you a lot of dividend. So now foreign stocks, coming back to the foreign stocks, they are usually divided into two categories: developed market versus emerging market. Now emerging stocks are very volatile but large returns sometimes. As I said, in aggregate, more volatility, more risk should pay you by more returns. Otherwise, it doesn't make sense. Like, why would you take more risk if you know on average it pays less than the thing that has less risk, right? So now developed markets examples are Europe, Australia, forest. Emerging markets, classic emerging markets are brick versus frontier markets. So that's basically should give you an idea of the flora and fauna, as they say, or like the complete map of different kind of stocks in the world. For example, domestic versus foreign versus emerging markets, many different categorization of domestic stocks. So these are all the many different categories before you even move to another asset class. Within stocks, you have so much variety. You could be investing in China, you could be investing in India, like how to get exposure. A lot of people, rather than investing in individual stocks, they go with the idea of taking macro view of the world. So basically, they have exposures, like exposure to emerging markets, exposure to China. There are exchange traded funds nowadays available just for uh, letting you have an exposure to a particular segment of the macro economy. So if you want, hey, I see that the Brazil is going to be doing better in next 5 years. I'm not saying it will, but I'm saying suppose if you thought that way, there is an ETF for just to invest in Brazilian stocks. There is an ETF for Indian stock. There is an ETF for Chinese stock. On the other hand, if you want to combine them all, there might be an ETF just for the emerging markets. So there are actually. And if you just want, hey, I just want to be in the large cap US stock, there's an ETF for that. So whatever kind of exposure you want, there is an ETF for that, most likely. So that is basically the idea behind these different categories, different segments of the market. Now, um, before I come to bonds, I want you to now go back and do some your own research, read about these things, and then do some Google, go to some famous investment related sites like Barron's, maybe CNBC, and get an idea of what are all these things. Like, see what people are talking about when it comes to stocks. Get an idea of the uh, general yeah, discussion environments within these categories. And then in the next session, we'll talk about bonds. Until then, I wish you all the best. Please take good care of yourself, and I'll see you soon. Bye.